Tim Carson was interviewed. Okay, so here's the thing. So we've been having a sell off in markets, in equity markets and crypto markets over the last since February 20th, right? And we talked about before this idea that the February 20th to March 20th window is a window of weakness that appears in that appears every year. There's 4 periods of weakness in to February, March, to June, July, to September, October, and then December, January. The thing is, the periods of weakness for December and in June are not normally cataclysmic because people are on vacation, and so there's less volume volatility that's happening around that time, and so it mostly squeezes out between September, October, and February, March.
Hmm.
And so what happens is that there's periods of liquidity that ebb and flow. Liquidity is the availability of dollars at any given time. And you can imagine if there's low liquidity, the market's more fragile at those times. And so if something happens, you can get exacerbation towards the downside. So right in the window, February 20th to March 20th, we get this drop. So we had this drawdown in the SPY. So with this drop here of 10%.
Wow.
And it happens regularly. Like corrections, this is just a normal correction. Over here, well, the famous one is COVID. This happened too, February 20th to March 13th. The next drop, where was the next March? Here, February 20th to beginning of March. This was a 5% drop. We have here February 20th to March 8th, 10% drop. So these periods of weaknesses happen pretty regularly. Again in March over here,
Yeah, but the most
February
current one,
ten
I,
percent
wa-
drop.
I watch CNN, and I know the most current one is because of Donald Trump. He said and did things. I don't know what exactly, tariffs or something, but he's tanking the amazing economy that Joe Biden left him. So,
Well, that's the thing. If within the window of weakness, a catalyst will have more effect,
mm,
especially a downside catalyst. And so it's no wonder that we get a pretty decent pullback over here. The question, and the same thing is happening within Bitcoin, right? So we have this drop over here. So this is February 20th top, and then went to the low of 20%. Right? Makes sense. Here's what's the interesting part. We have, let's go back to futures. All right, if we toss on our indicator, let's do show our weekly levels. All right, so just to show our weekly levels here, this is our indicator set from us from Ticket Profit, soon to be available to everyone for free. Right now, you have to contact me directly in order to get access to it. And basically, you see here how we pass this level, we bounce at that level. These are weekly volume weighted average prices, VWAP levels. We bounce over here, and then we bounce on over here, right?
right.
And so the thing is that there's actually another level down here. Oh, why is it not extended? Not. All right, I guess it's too far. But there's another level down here. 1 second, that we still have to get to, or that we could still get to. This level over here, which would coincide with this yearly moving average that's moving up, which is often where we bounce around. So we often use that as support. Over here, this was support towards the downside. This is where we broke above that level. That's where we normally go and touch again and again. So that yearly average like shows up again and again and again. And the question I had is like, did we get enough of the air out? And since it's just March 16th and we're headed into the final week of this window of weakness, I wonder if we can get another drop down. And so I thought it was pretty interesting. I just wanted to play this because I think it's a little wonky, but I mean, I like wonky things. And this is Kem Carson, who is I believe, he's the managing director of Kai Volatility. He manages investments in the option space. Very, very knowledgeable. And he's been calling all these window weaknesses, all these drops, all these rises, almost sometimes to the day, to the penny. Um, and here he is being interviewed by CNBC. Right. 1 second. Let me know if you can hear this.
Tonight, hopefully, with Rick Santelli. Rick, it is interesting that so many parts of the bond market, even high yield, junk bonds, they haven't really moved as stocks have fallen. It's a little weird.
It's a little loud.
Yeah, it is weird. And stocks are the dynamic affecting fixed income. And you know, there's a lot of inflation out there. So today we have guest inflation. Instead of one guest, I have two guests. Let's get right into it. We have Mike. We have Chem. What do you think about volatility here? Is it giving us any clues? Not volatility like choppy, like implied market option volatility.
Well, we had a pretty good, the administration came out and really told you what they were going to do. They're trying to take down the economy, take down the market. They weren't going to stand in the way. So it's well, documented. And so the volatility just hasn't been there. It's been a slow burn move down. The problem with slow burn down is if you have a hedge, it's not helping you here. And sometimes that can be the pain trade. Not the big vol explosion that everybody thinks. And for a lot of these hedge funds that are having the multi-strats that are having problems, that's probably the worst case scenario as well, because as the vol gets compressed, things start moving away from each other. You get dispersion and a correlation breakdown. So I think that's a little bit of what's going on. It's actually a pain trade.
All right, just to explain here, Peter, does that sound like gibberish to you?
No, but it's not the first time I've heard it.
All right, so just the idea for anybody else, the idea here is that when you're putting on a hedge, which in this case would be a put to the downside, you're paying a certain premium, paying a certain amount that says, hey, if the stock market drops by this amount, let me go ahead and you have to pay me out this insurance contract. And the thing is, the faster that happens and the more dramatic the move, the higher your payout. And so what he's saying over here is that people are buying hedges, but because the price is incrementally going down in this very steady way, even though it's been a big drop from the top 10%, it didn't all happen in one candle. It's been this stair step down. What happens is that when you buy that hedge, the protection to the downside, the price of that hedge is already high because you're already headed down. And so you didn't buy it while it was still low. Well, the price is up. You bought it when it started to go down, and so you have this high premium you're paying, and so then you're expecting, and you need an even bigger move in order to one, make money or even make that hedge break even, right? And you're not even selling the hedge at a break even because you're putting it on to protect yourself against the downside, so you don't even really sell it if it gets back up to zero. And then as the price keeps stair stepping down over this period of time, you have to keep buying that hedge in again, right? So if your hedge is for the day or for the week or whatever, you got to rebuy that hedge at a higher price.
Right.
And then you buy it at a higher price, and then it bleeds out slowly because the price doesn't like knife down like you're hoping, and you keep having to bleed this pain. What he's talking about is the pain trade. The pain trade is whatever in the market causes the most amount of pain to the most amount of people. That's where the market goes.
Right.
And so here, the most amount of pain is we keep going down, but steadily. So you can't take a wild bet, 10% down or something like that, because it might not get there in the time that your hedges is planned for, but then it might still get there after your hedge is expired.
Right.
So
that's what he's mentioned in there.
Trade as vol comes lower.
What do you think?
I think the correlation story is a big part of the story. We've seen about a 10% sell-off in the market since mid-February. Now, what we'd seen prior to that, we just saw a market where, S&P 500 would be not moved that much, but you'd see big moves up in Amazon, big moves down in Tesla. That compressed kind of index volatility. When volatility gets correlated, things start moving fast, and that's sort of what we saw over the last month. Now, today, we're rallying. We're seeing volatility come in. We're going into a weekend. Things are quieting down for today, but I think we've got some catalysts in the future that we got to look at.
Just because the big boys are doing something, does that mean they're going?
So there he's talking about that bounce that we saw at the beginning of at the end of last week, where we had a bounce up both in Bitcoin and in equities. Where this bounce up, so people go, volatility is lowering down, safer. People don't necessarily want to go into the next week and not be exposed to the market, right? Because if that's the low, they want to come back to the market and it's up 5% on Sunday, and so they buy back in on the weekend, or they cover their shorts. So if you've been shorting all week, you cover your shorts and you get this bounce back up. So these flows that come in, which I believe Cam is about to talk about right now, Vanna and Charm flows.
Going to be right?
Oh, absolutely not. And actually, what's happening right now is the big boys are having to delever. They're being forced into these trades. So this is a deleveraging event. Like Mike said, I'd be a little careful here. I mean, I think you can get a little rally into the weekend. These are Vana charm flows, and we talk so much about these buyback of deltas as vol decays. We're heading into a big quarterly March OPEX. That matters. The skew decays, and that sends deltas back into the market. But those are structural flows. And when those go away, you may not have anything behind it.
You know, Mike, you're.
So that's the thing I wanted to point out here that I'm like almost worried about, because the idea here is that actually, let me just finish this and then we'll talk about it.
Final thought, the last 40 seconds. If you had to sum up, how's the Fed going to deal with this?
You know, I think what next week it's looking like we're not moving rates at all. Now we have about a 30% chance we cut rates at the meeting in early May. But I think more importantly right now, we're not looking at this event-driven, let's look at volatility going into events. We're getting events out of nowhere. We're getting like news about tariffs, all this stuff, very unexpected. So you kind of can't look at events the same way. We're having an event almost every day right now, and that's something to think about.
Watch out for those.
All right. So he's talking about there, first of all, Ken was talking about the idea that the flows that we're seeing at the end of the week, where we have this bounce in Bitcoin and in equities, is happening because of these forced buyers, right? So if you are, sorry?
401ks?
No, that's passive investment. There are market makers, people have put on hedges, people have shorted the futures in order to protect their positions. They have to then, if they've shorted, they have to buy back those positions. Or if you're a volatility adjusted fund, or your strategy has to do with the level of volatility, as the volatility ebbs out, now you have to buy back just according to your rules. And so he's saying these Vanna and Charm flows, which is in the option space, these positions that need to be covered, they need to be bought back, causes a little bit of lift as you end the week as they take off those flows. But if all that resulted in there was a 2% bounce on equities, and for Bitcoin it was, we got a bounce up of 9%. Then the question is, if that's gone now, if they've all bought back their stuff, what happens next week if there is a catalyst? And he's saying the option space is thinly bought. The volatility is thinly bought, which means people are still not very hedged. So if a catalyst happens and there's no supportive flows, then we can have another leg down. And I would say for SPY, we can get another look down of like up to 13%, actually a little bit less than that, up to, we can get a run down here to here, which I believe is, another 6% down for the SPY, which would be a pretty big dramatic drop. And then for Bitcoin, let's call it 74, right, double that, so 12%, which to me would make total sense for that to happen in this last week as we head into the end of this window of weakness. And the last thing that Mike was saying there, the other guy at the end, was that the Fed, right now the markets are pricing in no cuts from the Fed on the 19th, this Wednesday, which would be supportive flows. If they're like going to cut, we're going to add liquidity to the market, we're going to lower interest rates, blah, blah, blah. The idea is that, okay, that would help support the bottom. But there is right now the market's pricing in no cut, and the times where the Fed doesn't do what the market is planning, very rare, because the one thing the Fed doesn't want to do is introduce volatility. And their whole forward guidance, their whole modus operandi is that what they say they're going to do, so that they can say things ahead of time, make the market move that way before they even actually do it. So if they do not want to add volatility right now, I'd be very surprised if they did. Even though I bet on Polymarket that they would, but it was like, put $20 down, you can make $600. What's I'll take that trade. I'll take that trade every month. So there's no supportive flows there, and then he's going, hey, and the Trump administration, we don't know what they're going to do one day to the next. And so, and if what they want is to bring the market down, I'd toss out some bad news this week, some catalytic news this week, get myself another leg down in the markets, get the 10-year yield to drop by 50 basis points, whatever it is, and help to bring that down. Plus, if we take a look at, actually, I want to do that here, we do on Sunday Fuel, but liquidity flows are not particularly high right now. They're only going to be there later. So I thought it was interesting. We could get another look down. I would not be taking any big longs this week. I'd be looking for opportunities to buy in on major dips, especially 6% down on the SPY and 12% down on Bitcoin.